Hey, what's up YouTube? Welcome to the Live Econ Guy. In this video, I want to talk about the impacts of inflation on household savings and debt. I recently came across a Forbes article which kind of discusses how inflation is impacting households, and it's essentially saying that it's having a bigger impact on the younger age groups rather than the older ones because the young people are buying more stuff, they're getting into more debt, while the older generations, they have that generational wealth. They don't need to really um, go into their savings to cover their everyday expenses, etc. So guys, what I did is I decided to pull the data for myself to see what's actually going on, how things are looking. So here we're looking at essentially the past 20 years of household savings and debt in the United States. On the left-hand side, you have the dollar amount, and on the horizontal axis, you have the legend, which you see the blue line, that's household savings, and then you have the orange line, which is household revolving debt. So this is actually basically credit card debt that we're looking here, and we're looking at the relationship between the two. So the story here essentially is before the great financial crisis of 2008, we had these very lax lending standards. So essentially anyone could go into a bank and get a credit card, and they would charge it up and do whatever. And as you can see, up until essentially the onset of the crisis, households had more revolving debt than savings, than liquid savings. And when we talk about savings here, by the way, we're talking about liquid savings accounts. So anything that you can take right away and pay off your debt. So after the crisis, the lesson kind of learned, as you could see, between around 2013 and 2018, is that you should have enough savings to cover your revolving debt at any time if you needed to dip into that. And then come COVID, we had these massive stimulus checks as well as the payment protection program, which businesses got, and people were essentially told to shelter in place, so don't go anywhere, just sit at home. So as a result, the average savings average household savings in the country skyrocketed, while the revolving debt decreased. But as you can see in this graph, you have these three blue spikes, which is spikes in household savings. That didn't last too long, so people decided to go out and spend all this money. They invested in various assets. Everyone did remodeling. Everyone bought an extra car. Everyone invested in a second house. So people were told that we're going to have all of this inflation due to this money printing and credit that was happening in the economy. And by the way, that's kind of the reason why we had all of these supply chain issues, is because all of this extra cash, all these extra savings that the average household in America had. So people decided to go out and spend all this money, and they spent like crazy. So come 2022, we see the two lines invert. So on average, a household now carries more revolving debt than the amount of savings they have. And what's adding on to that is that the Fed keeps increasing the federal funds rates, which is the short run interest rate. So that has a direct impact on anyone that's carrying this revolving debt. And by the way, as of today, the average interest rate for anyone that's paying interest on a credit card is 18.1%, something in that range. So all of these rate hikes, it's increasing this household revolving debt, and the Fed is not showing any signs of stopping this. So they're going to continue to hike the federal funds rate, which will put more pain on the consumers and households in the country. So that's all I wanted to share today, guys. Let me know what you see in the economy, what your situation is. I think it's true that people are tapping into their savings more and more these days to cover their expenses. We see more expensive gas, rent is skyrocketing, food is skyrocketing, things are getting more expensive. And at the same time, people are still spending, they're racking up their credit, and I think this can have adverse actions. So thank you for tuning into the Live Econ Guy. Feel free to leave a comment and like my video so we can get the algorithms working.